All right, next slide here. So holiday euphoria can be described as a time of the year where people lose their minds, get all giddy and crazy with festive spirit. It's beautiful. Many expect it to start after Halloween and extend into early January. So this is where our peeps were kind of looking to start this study, start of November into the end of the year, basically, is what we're looking at. So we got a lot of, and have gotten a lot of questions on this. So we're going to take a look at the historical annualized SPY returns from November 1st to January 15th. And then we're going to compare those results for the rest of the year. So this includes like New Year's, all that kind of stuff. So you're getting it's not specific to one specific holiday. It's all the holidays kind of at the end of the year.
I like it. And bucketing them all in one
place. Yeah. So we got a couple data points here to show you. I think you'll like what we got. So the study is 5 years of data in the SPY. So we're looking at just like, the COVID era SPY.
To date.
Yeah,
right?
to date, the market. The last 5 years.
Which has been an up market. I mean.
Which is a big part of what you're going to see here. Although the results are still, are still good for these neutral strategies, you have to take into the context of the market itself. And we've been doing kind of shorter duration studies for another reason other than just looking at the more recent time. But you have to keep in mind markets are way different than what they were 10 or 15 years ago. From a size perspective, your 16 Delta Strangle right now in SPY, what do you think it trades at?
16 Delta Strangle.
We'll go to December. We'll use the weeklies, 38 days to go. What do you think it trades for? 16
Delta Strangle?
Yeah. Implied volatility, basically near the low. So this would be kind of the low print of what you have typically seen.
Yeah, but wings are probably popping up a little bit as of late because those cheap options just stay cheap. I haven't looked.
The 16 Delta, what do you think?
$3-ish? Or is it?
576 right now, 38 days to go till expiration. So when we were talking about volatility at 18, 19, 20, right, $8, $9.
Yeah, sure.
I don't think I ever
really low.
I don't think I ever remembered selling a Strangle for $9 back in when I started.
No.
I mean, there's nothing there, and that's just a reflection of stock prices. We were trading Facebook when it was at 80.
Right.
It's at 700.
Yep.
That's just kind of how the market goes. So like you got to kind of look at studies and look at the data, and make it a similar denominator if you're going to look at like P&L. Because if you lose one Strangle this year, it's going to be the same loss as 5 Strangles or 10 Strangles 10 years ago.
Yep.
In terms of actual value.
Good point.
So we grouped the data. So again, our data set one is from November 1st to January 15th. We're looking at January 16th to October 31st. So there's a bigger window there. Obviously, we're looking at holiday versus not holiday. We're bucketing these into two. The group of data sets, we're going to look at implied volatility, so IV rank. So we're going to look at IVR in different ranges here. And then we're going to look at like participation rates. So we're going to look at like volume. We're going to look at win rate, average P&L, annualized return on capital, which is an interesting one, largest losses, all that stuff, and then compare the results. So this should be a good one.
Do it. Well, so here a little bit here also, by the way, 1825 up near its highs for the day.
Yes, a little choppy.
A little chop. Go ahead. I'm sorry.
Average SPY volume. So this is a question we get all the time of like, is there more trading that happens or does less trading happen really during holiday season? And you do typically see less trading as you get into the end of the year. During this holiday time. So it's clear that many traders participate in the markets more from January to October. That includes the summer, which is typically like kind of the lower volume time of the year. So you do generally, outside of holidays, like holidays are usually a slow, low volume grind. And that's not a shock because people go on vacations or spend time with family. Those are things that you do other than watch the market. So it usually is kind of a lower volume period of time. Not a shock. But the question becomes like, what do your trades look like? And that's what we're going to get here on this next slide. So if we jump to the win rate comparison by window. So again, we're looking at this at, the way you look at this is like you have date and then the implied volatility, the IV rank. So you have less than 30 or above 30, and you bucket it into those two sets there of your win rate, and the color coding gives you your win rate here as well. So you can see, your win rates across the board are good. They're what you would expect from a 16 delta strangle. I mean, they're right there. You kind of have a lower than expected, and this is a lot because of how big the move to the upside has been when in high IV and outside of this holiday window. When you're looking at high IV in the holiday window, it's been a higher win rate. And you take all these together, and they basically average out to exactly what you would expect with a 1 standard deviation strangle of about a 70% win rate. There are some times where, and this is just this 5 years. So we're looking at the market now.
Right. And this is because you have risk on both sides. You look at a 16% or 16 delta strangle, and you say I should have, an 84% return, which you do, a win rate on the high one. No, it's both sides. So on entry, it's closer to 75% or so, and that's really what it's coming out to play right here.
Yes.
We've had that positive drift to the upside.
Yeah. So during high IVR, win rates improved across the board.
Because you get that volatility contraction, and that's the edge, the 10 vol point edge that you get there on this, and that's what we play for, and that's why we say, maybe you ramp up or you look for more of these trades when volatility is higher. When volatility is not high, they're still viable trades. You just got to keep it a lot tighter, meaning your size. Watch your size. Watch your overall delta in your overall portfolio. You don't have that little kicker of being wrong and being right.
Mm-hmm.
Sorry.
No, that was perfect. That was exactly, you said it.
I try.
Succulently.
I try.
But really, your best spot was the holiday season high IVR, which isn't the most common occurrence. But if that does happen, think about it.
Yep.
Because we are coming into the holiday season.
I like it.
So the next slide here, we get into the average P&L over the buying power percentage in this window and the IVR regime. So we're looking at like all of them together. We're looking at high IVR. We're looking at low IVR. And when you bucket these together, obviously your high IVR in relation to the buying power, because the buying power doesn't really change all that much, but you're getting higher implied volatility and you're getting better win rate. You're getting more premium, so your wins are bigger. You expect that to be much bigger. And this is really why we focus on high IVR. And I know that the number of like 1% or 0.5% doesn't sound like a lot, but this is, if you're doing this on a 30 to 45 day window, you have 10 to 12 of these a year. And this is just on one position in a significantly bullish market.
Yes.
This is still 10 to 15%, if you have a mix of high IV, low IV, all of them together, and you just take one and 1.2% month over month as just one position, 12%, not sexy. It doesn't jump off the page considering the market, what has happened in the market, but it's still not bad.
No, it's not bad at all.
Not bad. Right. Risk-free rates 3 times risk-free rates.
I mean,
and this is just on like a 16 delta strangle.
Right, for not 3 times the risk. See, that's the
3 times the capital.
Not 3 times the capital. Yes,
because you're using a couple $1,000s on this.
Yeah, relatively speaking, you're using a small amount of money.
Yeah, you need to, if you're doing it from a notional perspective, you need 60 grand.
That's correct.
To get 1/3 the returns.
That's right.
So it's it's a lot different.
Yep, it is. You're right.
Assuming you're in a margin account.
Yep, that's correct.
Next slide here. So how does the risk profile compare when evaluating the risks associated with each scenario here? This historical annualized SPY returns from November 1st to January 15th, and then we're going to compare these results to the rest of the year from January 16th to October 31st. And so you can see here on the next slide is our CVaR. So this is your risk, right? So this is kind of your tail type risk on these trades in the last 5 years. And a lot of these have been to the upside, which is why these numbers are kind of lower than I would have expected. Because typically when you have these big downside moves, you pop in volatility. The tail losses are usually bigger on the downside, which we really haven't seen a ton of, at least not for long periods of time.
No, not for
these
long
trades kind of recover. So you can see here, even with like your drawdowns and your 5% tail drawdowns, they're pretty manageable here. I mean, you don't want to see a $2,000 drawdown, but when you're looking at this, it's not spooky.
No, it's not spooky for the holiday season that we're not looking at, which would be Halloween.
Yeah, well, the drawdowns, the losses are much lesser in this holiday season. Is kind of the one of the points here. So you kind of had that slow grind vol contraction is typically what you see during this period of time.
Very good.
Couple takeaways. That's all I got for you. The November to January window tends to deliver better returns and higher win rates. Performance and premium trades both improve during this stretch. And again, this is just looking at the last 5 years. So, things change, markets change. Next 5 years will probably be different.
Yeah, next 5 years will be different depending on what the next 5 years does in the market, right? Yeah. I mean, if we have a lot more choppiness, they're not going to have these kind of results.
The mechanics aren't different. Like, you can't say this time is different.
No, you can't.
But this market is different. It moves, things move, different problems, different successes.
Different agendas. Yes, 100%.
Risk was also lower, so the CVaR decreased by around 62% during that November to January period compared to the January to October window, which is the outside holiday period. This likely reflects fewer sell-offs, calmer markets, and stronger sentiment during the holidays. If you look back at the last 5 years, most of our problem times have been early in the year. You had the April sell-off this year. COVID was in March. Those are outside of this kind of holiday window.
You always have something, right? I mean, like that's like saying, well, this came, that came. Well, that's the outlier moves that you price into the market by the market having volatility, by those tail risk of those puts in ETFs like SPY, IWM, and Qs, by a tail risk to the upside of those stocks like the high flyers and the NASDAQ. So
for sure. It just happened to be the case. You could have a black swan event in December. I mean, you could have them anytime. So, it just so happens that this data set, we had them early in the year. So that's why your values skew in that period of time.
Very good, sir. Very good. Good job. You got one more.
Yeah, last one. Historically, the November to January window has outperformed the rest of the year, both in returns and consistency. Both traders should treat it as a probability tilt, not a guarantee. Combine it with volatility awareness and sound trade management for the best results. Of course, always comes down to managing trades, managing size, all that good stuff that we talk about.
Keep it tight, keep it simple. Don't overanalyze anything, and find high implied volatility to do something with, and treat everything as its own separate event.